Hello, this is Dale. On occasion, I like to update my subscribers on how well the strategy that I teach works. And today I closed out another very profitable trade on PepsiCo, a bull put credit spread. We had this on from May 10th of this year and closed it out today, July 7th. I've been a trader for greater than 4 decades, hedge fund manager, and a guest speaker at a number of different platforms. Currently, I am the coach of www.optionsinfinity.com, which I believe is the very best educational website available for teaching vertical spreads, which I believe is the absolute best way to earn consistent profits from the stock market. The reason why we focus on vertical credit spreads is they do give great returns when coupled with high probability trades. They yield monthly income on a consistent basis. There will be some losers as you go through. Losers are part of trading. You have to embrace those and just keep executing the trades as you see. This is a high probability trade. We're usually we're sellers of options, and we're buying one a little further out for protection. So this is the protection against loss versus selling naked, which actually the brokers require a higher margin, and the return on margin is actually better when we go in with a vertical credit spread. Being sellers of premium, the time is in our favor. So as every day goes by, the time value of the option that we have sold decays. One of the nice things about vertical credit spreads is you don't have to constantly watch the market. You don't have to chart hawk. And they are low anxiety trades. Now, the beauty of selling options is that you're taking advantage of the theta decay. We're selling out of the money options, and out of the money options only have time value. They don't have any real value. So as the time goes by, you get a rapid decay of that premium that somebody else has paid. You being the seller, you're taking advantage of that, and time is on our side, which is quite a bit different from how most people trade. In this example, I'm going to be going over a bull put spread. This is a type of option strategy that's used when the investor expects a rise in the price of the underlying asset. Now, the beauty of the vertical spread is that it doesn't have to necessarily go, it doesn't necessarily have to go up, or the asset doesn't have to rise. It can go sideways or it can go down a slight bit, and you're still going to be in a winning position versus a straight. Let's say you see a bullish trade and you put on a straight call. That straight call not only has to go in the right direction, but it has to go quickly. Otherwise, you're going to have time decay, and that's to our advantage. Bull put spreads profit when the market when your stock goes up, sideways, or slightly down. The strategy is constructed by selling one put out of the money, simultaneously buying another put that's further out of the money for protection. This is a chart of PepsiCo, and this is where we got into PepsiCo right here. And actually, what I saw here was a measured move. A measured move is a move that goes from a low to a high, back down to a low, and then makes a new high. Measured moves can show you the direction of the trade. And also I use the regression channel, and you can see the slope of the regression channel was up. So I wanted to put on a bullish trade right here. I sold the bull put by selling the 20 August 135 put way out of the money. So the only value this had, $2.02, was only time. There was no intrinsic value. But simultaneously, I bought the 20 August 125 put for 82 cents, so got a net credit of $1.20. Now, this was a kind of a neat trade because you can see that PepsiCo actually, once we got in, actually dropped a little bit, then came back up, then kind of went sideways, dropped a little bit, went back up, dropped a little deeper, and then finally we got out here. And the reason I got out here is we had made a nice profit, and we were only 4 days away from earnings. I don't like to take these trades into earnings because you're not sure exactly what's going to happen. The earnings could be exceptional, and the CEO might, the forward guidance they give might not be that good, and you never know. It's 50-50 as to whether it's going to go up or go down. So I always like to take the profits before that happens. So this is an example. We got in right here, and this is an example of the credit spread actually going sideways, slightly down, but then making a nice little run towards the end. And we bought it back on July 7th, buying back the 20 August 135 put for 48 cents, and then selling the 20 August 125 put for a net debit of 20 cents. So the profit we made was $1.20 credit minus the 20 cents debit, or $1 profit. Now, for one contract, there are 100 shares per contract. So that is $100 times $1, or $100 for one contract, or 83% of what we could have made if we would have gone all the way to expiration, which I never do. Now, that equates to $1,000 for 10 contracts, $5,000 for 50 contracts. And of course, I always have to say that past performances is no guarantee of future results. But if you've been a subscriber with me for a while, you've seen many, 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 many examples of profitable credit spreads that I share. This is the return on margin equity curve from 2019, January 2019, up until mid 2021. And this is the kind of curve that you can take to the bank. It is a positive expectation. Yes, we do have drawdowns. This was during the coronavirus, we had some drawdowns, but what kind of a recovery we had? We have losses, drawdowns, that's part of trading, but we have a positive expectation. And over the 2.5-year period, it actually was up about 900%. Once again, past performance is no guarantee of future results. Now, what does that equate to you? What I'd like to do is offer you to become a member of Options Infinity, because as a member, what we do is every 2 weeks you get together with me and I teach a webinar for about an hour where we go over, usually I go over a little bit of a learning tools, and then we talk about the current trades that we have on and what I see in the future. And then there's plenty of time for question. The other aspect of the membership is when I see a trade that I'm going to make, I send this out to all my members alerts. And what I want to show you on the next trade is that, yes, that on the next slide is, yeah, you saw that equity curve. Well, what does that mean? It means that a new member, as of January 2009, would have earned $7,082 by mid-2021. investing in only one contract per alert. The membership at Options Infinity is a low $99 per month. Cancel at any time. So over that 2.5 years, the cost was $2,970 with a net profit of $4,112 on one contract invested. Many members invest greater than 10 contracts. 10 contracts per alert would result in a net profit of $67,850. This is why I tell everybody that this website and these alerts are the best in the business. And what I'm trying to do is teach you how to do this so that you can earn while you learn. Once again, I have to mention that past performance is no guarantee of future results. I would like to invite everybody at this time to go to the website www.optionsinfinity.com and become a member and join me for a profitable journey into making consistent profits in the stock market. Hope you enjoyed this video. Bye-bye.